How much money does it really take to change your financial life? $10,000? $100,000? Or maybe what matters most isn't how much you start with, but what you actually do with the money you have. Michael is 32 years old and earns a regular paycheck. He follows the markets, but he has no interest in picking stocks every day or trying to predict which company will take off next. What he wants is much simpler: invest consistently in low-cost funds and give time a chance to work in his favor. But he still has an important decision to make. Should he build a portfolio designed to generate regular income, or should he focus more on long-term growth? Because even if you invest the same amount of money for the same amount of time, the way you divide that money among different funds can lead to very different results. One portfolio could start producing regular income sooner. Another might sacrifice some of that income today in exchange for the chance to build a much larger portfolio over time. And that's the part a lot of people miss. It's not just about which funds you own. How much of your money you put into each one matters too. In this video, we're going to build 2 different portfolios for Michael using 3 Fidelity funds. The first will focus more on income and dividends. The second will focus more on long-term growth. Then we'll answer the bigger question: what matters more to you, generating regular income or building a larger portfolio years from now? First, let's set the foundation. Michael's portfolio has 3 main jobs: generate income, grow his money, and make sure all of his investments aren't tied only to the U.S. market. For the income side, something like the Fidelity High Dividend ETF, or FDVV, could make sense. Michael's goal here is pretty straightforward. He wants to own pieces of large, profitable companies that regularly share part of those profits with shareholders. A dividend is simply a portion of a company's profits that gets paid out to investors. Generally speaking, the more shares you own, the more dividend income you can receive. But a high dividend yield by itself doesn't automatically make something a good investment. Sometimes a yield looks unusually attractive simply because the stock price has fallen. So instead of asking only, "How much does this company pay?" you also need to ask, "Can it keep paying that amount over time?" The second job is growth. For that, Michael is looking at a Fidelity index fund with heavy exposure to the NASDAQ. The goal here isn't to collect a large dividend. Michael wants more exposure to companies that have the potential to grow significantly in value over the years. Funds like this tend to have a heavier concentration in technology. Large companies involved in software, semiconductors, cloud computing, and artificial intelligence can make up a meaningful portion of the portfolio. These funds aren't necessarily designed to put a lot of cash in your pocket today. The idea is that if the companies inside them continue to grow, the value of the portfolio could grow faster over time as well. The third job is diversification. Michael doesn't want his entire portfolio depending on the U.S. market, so he also includes something like the Fidelity Total International Index Fund, which gives him exposure to both developed and emerging markets outside the United States. One mistake investors often make is assuming that because U.S. stocks have performed well in recent years, they're going to keep doing the same thing forever. There's no guarantee that the investment that performed best in the past will continue to lead in the future. And that's not really the point of diversification anyway. Diversification isn't about trying to own the best performing investment every single year. It's about making sure your entire portfolio isn't dependent on one country, one industry, or one market scenario. So now Michael has 3 different goals working together: income, growth, and exposure beyond the U.S. The next question is how much weight he gives each one. Because even with the exact same funds, you can build 2 very different portfolios. Let's call the first one the income-focused portfolio. In this version, Michael gives more weight to funds that generate dividends and cash flow. He doesn't completely remove growth from the picture, but growth isn't the main priority. The idea is to take the dividends he receives and reinvest them instead of spending them, allowing that income stream to become stronger over time. During the early years, Michael doesn't take those payments and put them in his pocket. He invests them right back into the funds. At first, the effect might not look very impressive. The numbers are small, and progress can feel slow. But that's how compounding works. Its real power shows up over time. As the years pass, it's no longer just the money you originally invested that can produce returns. The returns you earned in previous years can begin producing returns of their own. Michael isn't trying to get rich in a few years. His goal is to build a source of income that grows over time and could eventually reduce how dependent he is on a paycheck 20 or 30 years from now. Now imagine another version of Michael. Same age, same income, same amount of money invested at the beginning. But this Michael doesn't need regular income today. His main goal is to build the largest portfolio he reasonably can over the long run. So in the second approach, more of the portfolio naturally shifts toward growth. Let's call this one the growth-focused portfolio. Michael's thinking is pretty simple. If I'm not going to need this money for a long time, why wouldn't I put more of it into investments that pay less cash today, but may have stronger long-term growth potential? This portfolio still has dividends. It still has international diversification. But the main objective is clear. Grow the total value of the portfolio as much as possible over time. Here's where things get interesting. During the first few years, the difference between the two portfolios might not look nearly as dramatic as you expect. And this is usually where investors start getting impatient. People often want to know whether their strategy is working after 6 months or a year. But judging a 30-year investment plan based on the first few months doesn't make much sense. That's like trying to call the winner of a marathon right after the race starts. The real difference tends to show up later. A faster-growing portfolio doesn't just produce more gains in a given year. It can also leave you with a larger amount of money working for you the following year. And eventually, something interesting can happen. In the beginning, Michael's own contributions are doing most of the heavy lifting. But as the portfolio grows, the investment returns themselves can start having a much bigger impact. Every time Michael adds more money, he isn't just increasing the balance in his account. He's also increasing the amount of capital that compounding can work on. So early on, Michael is doing most of the work. But given enough time, the portfolio's own growth could eventually become larger than the amount Michael contributes each year. Now let's put the two approaches side by side. An income-focused portfolio may provide higher and more consistent cash flow. That can be especially attractive for someone approaching retirement or for someone who wants regular income from their investments. A growth-focused portfolio may pay out less cash today, but the trade-off is that the investor is aiming for a larger total portfolio value over time. So which one makes more sense? There isn't one answer that works for everyone. A better question is, what are you investing this money for? If you're 28 years old, you have a steady income, and you have 30 years ahead of you. The amount of dividend income you receive today may not matter very much. But if you're 58 and you expect your paycheck to shrink or disappear within the next few years, regular investment income could become much more valuable. And that brings us to an important question about the growth portfolio. You might be thinking, if my portfolio is going to be bigger anyway, why not just sell 4% of it every year in retirement? Why would I need a dividend-focused portfolio at all? That's a reasonable question. Let's say you retire with a $700,000 portfolio. 4% of that is $28,000 a year. That works out to about $2,333 a month. On paper, the numbers look perfectly fine. But average returns aren't the only thing that matters in investing. The order in which your gains and losses happen can matter just as much. Imagine the market falls 25% during your first year of retirement, and at the same time, you need to sell some of your investments to cover your living expenses. The problem isn't just that your portfolio has gone down in value. You're also selling investments that could have participated in the recovery when the market eventually comes back. That's known as sequence of returns risk. And major market declines during the first few years of retirement can affect a long-term plan much more than people expect. But it would also be a mistake to take that idea and conclude that dividends are always better. Because dividends aren't free money. Companies can reduce their dividends. They can even stop paying them completely. and high-dividend companies can underperform growth companies during certain periods. So treating dividend investing as completely safe and growth investing as automatically risky is too simplistic. A solid investment plan should take several things into account at the same time: your goals, your time horizon, the amount of risk you can handle, and how you're likely to behave when the market gets rough. At the beginning, Michael was asking one simple question: what's the best Fidelity fund? But once he looked a little deeper, he realized that wasn't really the question he needed to answer. The better question was, what do I actually want this money to do for me? Because there is no single best investment for everyone. Whether an investment makes sense for you isn't determined only by what it returned in the past. Your goals, your time horizon, your risk tolerance, and how you behave during difficult markets matter just as much. And that's one of the ideas I want you to take away from Money with Tommy. Wealth usually isn't built with one huge move. It's built through good decisions repeated consistently for years. Michael's results 20 years from now won't be determined only by which funds he chooses. They'll also depend on whether he keeps investing consistently. Will he panic and sell when the market drops? Will he stick to his plan when everyone else is chasing whatever stock happens to be popular that year? Because over the long run, high returns alone aren't enough. Patience, consistent contributions, reasonable costs, and good investing behavior all have to work together. You can earn great returns, but if you're impatient, you may end up selling at exactly the wrong time. You can invest consistently, but if your costs are too high, fees can quietly eat away at a meaningful part of your compound growth over the years. And even owning great funds isn't enough if you don't have a clear plan. Without one, every major market drop can make you question your strategy and change direction. That's one of the strange things about investing. People are always searching for a better fund, a better stock, or a higher return. But a lot of the time, what really makes the difference is how the investor behaves. So if there's one question you remember from this video, make it this one. Before asking, will this fund make me more money? Ask yourself, what do I actually want this money to do for me in the future? Do you want it to generate regular income? Do you want it to grow as much as possible over the long run? Do you want exposure outside the United States? Or do you want some balance between all three? The answers to those questions can tell you more about how your portfolio should be built than the name of any single fund ever could. And one more thing needs to be clear. None of the examples in this video guarantee what will happen in the future. Returns can change, dividends can fall, market valuations can change. So choosing a fund simply because it had the highest return in the past isn't a very sound strategy. Think of it like driving while staring into the rearview mirror. The past can help you understand where you've been, but you still have to look at the road ahead to decide where you're going. So ask yourself this: if you had $10,000 today, would you put it into a portfolio designed to give you more regular income in the future? Or would you leave it invested for the next 20 or 30 years and focus on building the largest portfolio you could? Leave just one word in the comments: income or growth. If you want to make smarter decisions with your money, better understand investing psychology, and build a practical system toward financial freedom, subscribe to the channel. I'll see you in the next video.